In September 1929, a stockbroker named Michael Meehan noticed something unusual. The ticker tape, the stream of price data flowing through his office, began stuttering. Not crashing, stuttering. Orders took longer to fill. The spread between bid and ask widened. Trading volume surged, but fewer stocks were actually moving. Meehan recognized the pattern from smaller panics he'd witnessed in his career. He liquidated his entire portfolio within 48 hours. 6 weeks later, the Dow fell 25% in 2 days. Meehan wasn't a prophet. He simply understood that certain market conditions don't resolve. They detonate. Today, that exact pattern has returned. The same technical warning signs that preceded 1929, 1987, 2000, and 2008 are visible in current market data. Not predictions, not theories. Measurable conditions that historically precede violent repricing. This isn't about timing a crash or predicting the future. This is about recognizing when market structure becomes unstable, when liquidity thins to the point where normal selling pressure triggers cascades, when concentration reaches levels that mathematically amplify volatility. The pattern doesn't guarantee catastrophe. It guarantees fragility, and fragility, in markets built on leverage and momentum, has consistent consequences. Market liquidity measures how quickly you can sell an asset at its stated price. In stable conditions, you click sell, someone buys, transaction complete. Price barely moves. That's deep liquidity. Shallow liquidity means your sell order moves the price noticeably. Your transaction itself becomes part of the pricing mechanism because there aren't enough buyers absorbing volume at current levels. The New York Stock Exchange average daily trading volume in 1929 peaked at roughly 5 million shares. By October, volume surged to 16 million shares on Black Thursday. The exchange couldn't physically process the orders. The ticker tape fell hours behind real-time trading. Brokers were selling stocks at prices that had already collapsed before the tape reported the execution. Liquidity didn't just thin, it vanished. Sellers overwhelmed the system's capacity to match buyers. Fast forward to October 1987. Program trading, automated computer systems executing large orders, had become standard practice. Portfolio insurance strategies, designed to limit losses by automatically selling when prices fell, created a hidden layer of coordinated selling pressure. On October 19th, the Dow fell 22.6% in a single session. Trading systems couldn't handle the volume. The New York Stock Exchange considered closing early. Multiple securities halted trading entirely because no buyers existed at any price. Liquidity evaporated within hours. March 2000 marked the peak of the dot-com bubble. The Nasdaq hit 5,048. Liquidity appeared robust. Millions of shares traded daily. But beneath the volume, a structural problem festered. Most trading concentrated in a narrow set of technology stocks. When sentiment shifted and selling began, liquidity fragmented. Stocks that traded millions of shares daily suddenly couldn't find buyers. Spreads widened. Execution became difficult. By October 2002, the Nasdaq had fallen 78%. September 2008 demonstrated liquidity collapse in modern form. Lehman Brothers filed for bankruptcy on September 15th. Within days, overnight lending markets froze. Money market funds, considered ultra-safe, broke the buck, meaning share value fell below $1. Institutional investors couldn't access cash. The commercial paper market, where corporations fund day-to-day operations, seized. Credit default swap spreads exploded as counterparty risk became unquantifiable. The Federal Reserve had to create emergency facilities just to keep basic transactions functioning. The pattern across all 4 episodes: liquidity appears adequate during the expansion. Volume is high. Trading feels smooth. Prices rise steadily. Then a catalyst: 1929's margin calls, 1987's program trading triggers, 2000's sentiment shift, 2008's credit freeze, exposes the underlying fragility. What appeared to be deep liquidity was actually surface activity concentrated in popular securities. When broad selling pressure arrived, The market structure couldn't absorb it. Today's market exhibits similar warning signs. The bid-ask spread on S&P 500 stocks has widened compared to 2019. Market depth, measured by the volume of orders sitting at prices near the current quote, has thinned. High-frequency trading firms provide much of the visible liquidity, but their algorithms withdraw during volatility. They're present when liquidity isn't needed and absent when it is. Average trade size has decreased while order fragmentation has increased, meaning the same volume gets executed through more smaller transactions. This is a hallmark of shallow liquidity. The market can process steady flow, but lacks capacity to absorb sudden size. Exchange-traded funds, which own significant portions of underlying stocks, create structural linkages that can amplify selling pressure. ETF arbitrage mechanisms work smoothly in normal conditions. Under stress, they can transmit volatility from the ETF into the underlying securities simultaneously, overwhelming available liquidity. The liquidity mirage exists because modern market structure prioritizes speed over depth. Transactions execute in microseconds, creating the appearance of efficiency. But efficiency isn't resilience. When selling pressure intensifies, the fast liquidity disappears instantly, leaving slower participants to absorb losses in a market suddenly devoid of bids. In 1929, a handful of stocks dominated market capitalization. Radio Corporation of America, General Motors, and a few major utilities represented a disproportionate share of the Dow's value. When these stocks fell, they dragged the index with them. The concentration created mathematical amplification. Each dollar of selling pressure in these megacaps moved the index more than equivalent selling in smaller stocks. By 1987, portfolio insurance strategies meant institutions held similar positions in large-cap stocks and futures contracts. When automated selling began, it hit the same securities simultaneously. The concentration of positions in megacaps meant selling pressure concentrated in the exact stocks that determined index value. The S&P 500 fell 20.4% in one day, largely because megacap selling overwhelmed the entire market structure. The year 2000 concentration centered on technology. At the peak, Microsoft, Cisco, Intel, and Oracle represented over 20% of the Nasdaq's value. When technology stocks fell, index declines accelerated because the selling concentrated in the heaviest weighted names. Concentration transformed a sector correction into a market collapse. In 2008, financial stocks like Citigroup and Bank of America had enormous market capitalizations before the crisis. Their collapse removed trillions in market value. But the concentration wasn't just in financials, it was in the assumption that housing-backed securities were safe. When that assumption broke, concentration manifested through correlated selling across seemingly diverse asset classes. November 2025 shows concentration at historic extremes. The top 7 stocks in the S&P 500, Apple, Microsoft, Amazon, Google, Meta, Tesla, and NVIDIA, represent approximately 30% of the index's total market capitalization. Never before have so few companies held such disproportionate weight. The previous record came in March 2000, when the top 7 represented roughly 25%. Current concentration exceeds even that bubble peak. This concentration creates mathematical fragility. If these 7 stocks fall 20%, the S&P 500 falls 6%, even if the other 493 stocks don't move. Index funds and passive strategies, which now represent roughly 50% of equity market assets, must hold these megacaps in proportion to their index weight. Active managers often overweight them further to avoid underperformance. This creates synchronized positioning. When these stocks fall, almost every institutional portfolio falls simultaneously. The concentration also distorts market cap weighted index performance. The S&P 500 can rise while the median stock in the index falls. This has occurred repeatedly in 2024 and 2025. Equal weighted versions of the S&P 500 have underperformed the cap-weighted index by significant margins, meaning a small number of stocks are lifting the index while the majority struggle. This isn't broad-based strength. It's narrow leadership masquerading as market health. When concentration unwinds, it unwinds violently. Selling pressure in megacaps overwhelms available liquidity because these are precisely the stocks that everyone owns in similar proportions. There's no diversified buyer base to absorb selling. Instead, institutional selling hits the market simultaneously, each participant trying to exit positions that every other participant also holds. The concentration problem is compounded by options activity. Dealer hedging of options contracts creates additional buying and selling pressure in megacaps. When implied volatility rises, dealers must sell stock to hedge their positions. When prices fall, hedging requirements intensify, forcing more selling. This dynamic, known as gamma exposure, means that concentrated megacap positions amplify volatility through derivative hedging flows on top of the underlying concentration risk. History doesn't offer examples of sustained concentration at current levels resolving smoothly. Previous peaks in concentration, 1929-2000, ended with severe repricing. The mechanics aren't mysterious. Concentration creates correlated positioning. Correlated positioning eliminates diversification. When selling begins, it hits the same stocks that everyone owns, overwhelming liquidity and amplifying declines. Volatility measures price movement. Low volatility means prices move steadily. High volatility means prices swing dramatically. Markets naturally cycle between these states. But extremely low volatility, sustained over long periods, historically precedes violent volatility spikes. This isn't intuition, it's measurable in VIX futures, realized volatility statistics, and options pricing. In 1929, price stability characterized the summer months before the crash. Stocks rose steadily. Daily moves were small. Traders interpreted this as strength. It was actually tension building in a system with hidden fragility. When selling began in October, volatility exploded because the market had no recent experience absorbing sharp moves. The months before October 1987 showed similar compression. The VIX didn't exist yet, but realized volatility, actual price movement measured historically, was remarkably low through the summer. Portfolio insurance strategies were designed for gradual declines. They had no mechanism to handle the velocity of selling that arrived in October. Low volatility bred complacency, which amplified the crash. In 1999 and early 2000, volatility remained subdued despite the Nasdaq reaching extreme valuations. Prices rose consistently. The VIX traded below 20 for extended periods. Options were cheap. Traders betting on continued stability were selling volatility to collect premium. When the Nasdaq peaked and selling began, implied volatility spiked from below 20 to above 40 within weeks. Those short volatility positions became liabilities, forcing additional selling. The year 2007 exhibited one of history's most dramatic volatility compressions. The VIX fell to 10, multi-decade lows in the months before the credit crisis emerged. Subprime mortgage defaults were accelerating, but equity volatility remained historically suppressed. The disconnect between underlying credit stress and surface equity calm preceded a violent reversal. By October 2008, the VIX spiked above 80, the highest level ever recorded. Today's volatility profile mirrors these pre-crash periods. Through much of 2024, the VIX traded below 15, below its long-term average. This occurred despite inflation uncertainty, interest rate volatility, geopolitical tension, and banking sector stress. The compression suggests that volatility itself is being systematically suppressed, likely through structured products and dealer hedging that benefits from stable prices. Volatility compression creates mechanical risks. Many institutional strategies profit from selling volatility, collecting premium by betting that prices will remain stable. These strategies include structured notes, variance swaps, and options overriding programs. When these positions are large, they create reflexive stability. Dealers hedging these products buy into weakness and sell into strength, dampening price movement. This works until it doesn't. The danger arrives when an exogenous shock forces rapid repricing. The structures designed to suppress volatility become amplifiers. Dealers must unwind hedges quickly. Structured products face margin calls. Volatility sellers scramble to exit positions simultaneously. This occurred in February 2018 when the VIX spiked from 10 to 40 in 2 days, destroying volatility targeting funds and causing sharp equity declines despite no fundamental catalyst. Current conditions show elevated positioning in short volatility strategies. Open interest in VIX futures and options is historically high. A significant portion represents investors betting on continued low volatility. If a catalyst forces the VIX higher, these positions face mechanical losses that trigger further volatility spikes. The compression itself becomes the vulnerability. History shows that extended volatility compression doesn't resolve gradually. Markets don't slowly transition from low volatility to high volatility. The transition is abrupt, often triggered by seemingly minor catalysts. Low volatility breeds complacency and leverage, which amplify the subsequent spike. The longer volatility remains suppressed, the more violent the eventual expansion. Leverage amplifies returns in rising markets and amplifies losses in falling markets. Margin debt, options leverage, and structured products create hidden layers of risk that become visible only during declines. Each prior crash featured leverage that appeared manageable until prices fell. In 1929, margin requirements allowed investors to buy stocks with only 10% down payment. The remaining 90% was borrowed. This leverage worked beautifully as prices rose. A 10% stock gain generated a 100% return on invested capital. When prices fell, the mathematics reversed. A 10% decline eliminated the entire equity position, triggering margin calls that forced selling, which pushed prices lower. Triggering more margin calls, the leverage created a self-reinforcing collapse. In 1987, portfolio insurance represented synthetic leverage. Institutions didn't borrow directly, but the automated selling strategies created leverage-like dynamics. As prices fell, programs sold futures contracts to hedge equity positions. This selling pushed futures prices down, which created arbitrage opportunities that spread selling into underlying stocks. The leverage wasn't in borrowed money, it was in the structural selling pressure that intensified as prices declined. The year 2000 saw leverage in technology stocks through concentrated positions and implicit call option exposure. Many investors held large portions of their wealth in single tech stocks that had appreciated dramatically. This concentration created leverage because a small price decline in one stock produced large portfolio losses. When the Nasdaq fell, concentrated positions forced selling to raise cash or meet obligations, accelerating the decline. In 2008, leverage appeared throughout the financial system. Banks operated with leverage ratios above 30 to 1, meaning each dollar of equity supported $30 of assets. Hedge funds leveraged structured credit products. Homeowners carried mortgages on appreciating properties, believing prices wouldn't fall. When housing prices declined, the leverage magnified losses. Banks faced insolvency. Hedge funds collapsed. Homeowners defaulted. Each layer of leverage transmitted stress to connected counterparties, spreading the crisis systemically. Current leverage metrics show concerning patterns. Margin debt, while below 2021 peaks, remains elevated compared to historical averages relative to GDP. Investors are borrowing to buy stocks. Options activity has exploded, with call option volumes reaching historic highs. Options provide leverage. A small investment in options controls large stock positions. This leverage is asymmetric. It expires, sometimes worthless, sometimes triggering large stock purchases or sales when dealers hedge. Corporate leverage deserves attention. Many companies borrowed heavily during the low-rate environment of 2020-2021. This debt now faces refinancing at higher rates. If business conditions weaken, leverage that seemed manageable becomes unsustainable. Downgrades, defaults, and credit stress would ripple through corporate bond markets, which are interconnected with equity markets through convertible bonds and volatility transmission. Private equity represents hidden leverage. Firms borrow to buy companies, improving returns when investments appreciate. The private equity industry holds trillions in assets, much of it financed with debt. If valuations fall, when, not if, these investments are eventually marked to market, the leverage will amplify losses. Public market volatility transmits into private markets with a lag, meaning current leverage levels may not yet reflect the risks building beneath the surface. Structured products contain embedded leverage. Many retail and institutional products offer enhanced yields by selling volatility or taking leveraged equity exposure. These products appear safe because they're marketed as principal protected or yield enhancing. But the protection depends on stable conditions. During market stress, structured products can face rapid losses that trigger redemptions, forcing liquidation of underlying assets, which accelerates declines. Leverage doesn't cause crashes, but it determines their severity. Markets can decline without leverage, but leveraged declines accelerate because each price drop forces selling. The current leverage profile, spanning margin debt, options activity, corporate borrowing, private equity, and structured products, creates multiple layers where falling prices trigger forced selling. This is the acceleration mechanism that transforms corrections into crashes. Markets don't crash randomly. They crash when structure becomes unstable, when liquidity thins, concentration peaks, volatility compresses, and leverage builds. These aren't separate risks. They're interconnected vulnerabilities that amplify each other. Consider the sequence. Liquidity thins as trading concentrates in fewer stocks. Concentration increases as a small number of megacaps dominate index weights. Volatility compresses because stability-enhancing structures and short volatility positioning suppress price movement. Leverage builds because low volatility and rising prices encourage borrowing and risk-taking. These conditions coexist before major declines. In 1929, liquidity was thin relative to trading volume. Concentration was high in a few leading stocks. Volatility was low through the summer. Leverage was extreme via margin debt. When selling began, each factor amplified the others. In 1987, liquidity infrastructure couldn't handle electronic trading volume. Concentration existed in large-cap stocks held through index strategies and portfolio insurance. Volatility was compressed. Leverage came through portfolio insurance structures that sold automatically as prices fell. In 2000, liquidity was shallow outside the leading tech stocks. Concentration was extreme in NASDAQ leadership. Volatility remained low even as valuations reached unsustainable levels. Leverage existed through concentrated positions and implicit exposure to rising prices continuing. In 2008, liquidity disappeared when credit markets froze. Concentration existed in financial stocks and in structured credit products held across institutions. Volatility was at multi-decade lows in 2007. Leverage saturated the system through bank balance sheets, household mortgages, and structured products. Today's market exhibits all four conditions simultaneously. Liquidity is thin beneath the surface of high-frequency trading. Concentration exceeds prior peaks, with 7 stocks representing 30% of the S&P 500. Volatility is compressed below long-term averages. Leverage is elevated across margin debt, options, corporate borrowing, and structured products. The pattern doesn't predict the catalyst. It identifies vulnerability. Something will trigger selling, a geopolitical event, earnings disappointment, policy shift, credit event, or simply a technical breakdown. The trigger matters less than the structure. When structure is fragile, any catalyst can initiate a cascade. Historical data supports this framework. Research analyzing pre-crash periods confirms that combinations of low liquidity, high concentration, compressed volatility, and elevated leverage create statistically significant predictive signals. These aren't guarantees. Markets can remain fragile for extended periods, but they identify conditions under which normal selling pressure produces abnormal results. The current pattern's persistence is notable. These conditions have existed for months without resolving. That doesn't mean they're benign. It means the tension is building. Markets can remain overextended longer than fundamental analysis suggests, but they don't remain overextended indefinitely. Reversion occurs, and when it does against a backdrop of structural fragility, the reversion is violent. Timing market crashes is impossible. Even traders who recognized the vulnerabilities in 1929, 1987, 2000, and 2008 couldn't predict the exact day selling would begin. Michael Meehan got lucky. His liquidity observations in September 1929 gave him weeks of warning. Most professionals missed it, but magnitude is more predictable. When markets crash from conditions of high concentration, thin liquidity, compressed volatility, and elevated leverage, the declines tend to be severe. The 1929 crash erased 90% of the Dow's value over 3 years. The 1987 crash produced a 22.6% single-day decline. The 2000 to 2002 bear market saw the Nasdaq fall 78%. The 2008 crisis cut the S&P 500 by 57%. The pattern suggests that current conditions, if they resolve negatively, would produce a decline in the 30 to 50% range at minimum. This isn't speculation, it's mathematical. With 30% of the index in 7 stocks, a 50% decline in those megacaps produces a 15% index decline, even if nothing else moves. In reality, broad selling would accompany megacap weakness, amplifying the drop. The duration of prior crashes also provides guidance. Once selling begins, it typically takes weeks to months to reach maximum panic. The 1929 crash played out over 2 months. The 1987 crash compressed into days. The 2000 to 2002 decline took 2.5 years. The 2008 crisis lasted 18 months. Current leverage and concentration suggest velocity would resemble 1987, rapid and severe, rather than the grinding bear markets of 2000 or 2008. Recovery timelines vary. After 1929, the market didn't reclaim the 1929 peak until 1954. 25 years. After 1987, recovery took 2 years. After 2000, the Nasdaq took 15 years to exceed its 2000 high. After 2008, recovery took 4 years for the S&P 500. The recovery timeline depends on whether the crash stems from valuation excess, structural breakdown, or both. Current conditions reflect both. Valuations in megacaps remain extreme, and structural vulnerabilities are building, suggesting recovery would not be swift. Investors face a decision framework: acknowledge the pattern or dismiss it. Dismissing it requires believing that current conditions are different from prior pre-crash periods. That current concentration is sustainable. That liquidity is adequate despite measurable thinning. That volatility compression will persist indefinitely. That leverage won't amplify declines. Acknowledging the pattern doesn't require predicting the catalyst or timing the top. It requires recognizing that risk has asymmetrical distribution. Upside from current levels is constrained by valuation and concentration. Downside is amplified by structural fragility. The expected value of maintaining full equity exposure under these conditions is negative. Michael Meehan survived the 1929 crash because he recognized warning signs and acted before the cascade. His strategy was simple: reduce exposure when structure became unstable. He didn't time the exact top, he reduced risk when the risk-reward became unfavorable. The lesson applies today. Current market conditions don't require predicting a crash. They require acknowledging that risk exceeds reward at structural extremes. Several strategies reduce exposure to fragility without requiring perfect timing. Position sizing matters. Concentrated portfolios amplify both gains and losses. Diversification across asset classes geographies, and investment styles reduces single-point exposure. If megacaps decline sharply, diversified portfolios suffer less because losses concentrate in the overweighted names. Liquidity management is critical. Maintaining dry powder, cash or liquid equivalents, provides options during volatility. Forced sellers during crashes realize losses. Cash holders can buy assets at distressed prices. The difference in long-term returns is substantial. Volatility hedging through options offers insurance against tail risk. Buying put options on indices or volatility products costs premium but provides downside protection during crashes. This insurance approach has clear costs but bounded risk. Reducing leverage eliminates forced selling risk. Borrowed money amplifies gains but also creates margin call risk. During crashes, leverage transforms paper losses into realized losses through forced liquidation. Deleveraging before stress eliminates this mechanical risk. Sector rotation toward defensive positions reduces sensitivity to growth stock corrections. Megacaps are predominantly growth stocks trading at high valuations. Shifting toward value, dividend-paying stocks, or defensive sectors like utilities and consumer staples reduces exposure to concentrated leadership. Alternative assets, uncorrelated with equity markets, provide diversification. Commodities, managed futures, and certain hedge fund strategies perform differently during equity declines. These allocations reduce overall portfolio volatility. The core principle is risk management, not prediction. Nobody knows when fragility will resolve into volatility, but risk-aware investors recognize when the structure favors preservation over aggression. Current conditions strongly favor preservation. The pattern that preceded 1929, 1987, 2000, and 2008 is present again. Liquidity has thinned, concentration has reached extremes, volatility is compressed, leverage is elevated. Each condition alone warrants caution. Together, they create fragility, market structure vulnerable to cascades. History doesn't repeat, but structure does. When markets build tension through thinning liquidity, extreme concentration, compressed volatility, and elevated leverage, that tension eventually releases. The release is rapid and severe because the structure amplifies selling pressure. The current pattern doesn't guarantee a crash next week or next month. It confirms that the market operates near structural limits. When operating at limits, small shocks produce large movements. The mathematics are clear. The history is documented. The pattern is here.